The next question in the mailbag is a really interesting question. And the question is, I hear people say that the main reason that stocks go up and down is emotion. Is that correct? Unfortunately, most people don't really understand how stocks work. And if you ask the question, how do stocks work? You're generally going to get a response that stock prices are driven by emotion, or maybe they're going to say that there are more buyers than sellers or more sellers than buyers, which is absolutely correct and absolutely wrong at the same time. Let's start with absolutely right. If you're a short-term trader, stock prices are driven by emotion. Companies only release information like earnings every 3 months or so. And when you're in a vacuum, when stocks suddenly plummet or rise 10% in a few days between earnings releases, then what's happening? The answer could be summed up to one word, and that's speculation. Between earnings releases, people are speculating. People are speculating that the next earnings release will be good, or it's going to be bad, or the economy is going to be strong, or the economy is going to be weak, or that we're going to have a change in management, or the company may have a takeover candidate. The question that I must ask there is, why do you listen to the business news? Their focus is completely on the short term. And this is for the main reason is that they sell advertising and they want to sensationalize the news so people will read it. They don't want to give the basic boring news that nothing's really happening for 90 days between earnings. For longer term investors, day-to-day choppiness isn't really a factor that they should focus in on. Do you really think that Warren Buffett gets his knickers in a knot because Apple, which makes up 6% of his portfolio, goes up or down 5% in a day? Over time, the key driver of stock price movements is earnings per share growth. Since early 2015, Adobe's earnings have grown from 62 cents to $7.92 a share. And the stock has risen from $77 to $474. During that period, the price earnings ratio, a measure of emotion, has declined from 160 times earnings to 60 times earnings. During this period, Adobe's price has had 3 drops of greater than 20%. Traders would have been stopped out on these drops and would have missed these tremendous returns. Investors who would have bought on these dips and seen them as opportunities would have benefited. So if you're a longer term investor, focus on earnings trends, find companies with longer term consistent and predictable earnings growth trends that are expected to continue into the future, where the stock is available at a reasonable price, and don't get fooled by the short-term swings or what people are telling you on TV.